Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Hello, investors. You know, if you're hearing that instead of "Good morning, everybody," you got me instead of Dan. We got some good news on the Revere front today from some of the guys that I'm so happy to be working with. First of all, Ted and Connor making their debut this week on IBD Media with the IBD podcast on Wednesday with Justin Nielsen. This one's free. All you got to do is go to the IBD website. It's also was on YouTube Live. Search it out. They walk through their process and Revere's overall process, including how they got to be where they are today. Check that out. And joining us today again is Jackson Neidich, and congrats to Jackson passing his Series 65 this week. That means he is officially an investment advisor representative, and you're going to be seeing a lot more of Jackson on our nightly videos and also on the podcast. So some good stuff to report. What do we see in here? What do we normally do? Well, and what do we know and what don't we know? Well, we do know that we're in a bull market. We've been in a strong uptrend since the O'Neill follow-through day in early April. We also know that we're in a power trend, which is a significantly strong uptrend as defined by Mike Webster, Charles Harris, and Justin Nielsen from Investors Business Daily. And we also know that those bullish trends don't give up easily. We also know, however, and this is a potential fly in the ointment, interest rates. We've evolved or devolved, I should say, from looking for the next cut to the market actually pricing in the next raise. And the reason for that is some inflation data came in strong to the upside this week. And inflation data by itself is nothing, but rates actually reacting to that and breaking to the upside is definitely a potential problem. Nothing kills growth names more than higher interest rates, because the prevailing theory is that higher cost of lending impacts growth names because they typically are borrowing money in order to sustain their growth. So what we're looking at right out of the bat is not a chart of the S&P 500. We're looking at a chart of the 30-year Treasury bond, and that's about as clear a breakout as you will see. We started it earlier this week on Tuesday and Wednesday. We had a pullback to the rising 8-day exponential moving average on Thursday, and then a gap up overnight to the upside. That gap up, this is the 30-year. Let me also show the 10-year, which is really more important because a lot of interest rates are pegged to this, particularly mortgages. This is a very clear gap up as well, not clearing the left side of the base going back to early last year the way the 30-year is, but still troubling nonetheless. And let's go to the S&P 500 now. And what we got this morning was a gap down. I'm going to bring up a 5-minute chart here. We'll talk about the positives and the negatives. The positive is that we found the low within the first 15 minutes, tested it, and we've been rallying near the highs of the day and putting in a little cup and handle here on the intraday 5-minute pattern. What we're seeing is, and I'm going to bring up two instruments to play rising interest rates. TBT is the 2 times long bonds. TMV is the 3 times long bonds. And what we're seeing here is that look at this 5-minute chart here, and now look at the S&P 5-minute chart here, and you're seeing a kind of a mirror image of what's going on here. As rates are rising, we're seeing the S&P come off. So let's take a look at TLT, which is actually the inverse. And this is what the S&P is looking at. I should say this is the mirror image. This is what you're seeing on the S&P. As interest rates go higher throughout the day, the market's coming off. As interest rates come down, the market is rallying. So it's important for right now on the S&P, I'm going to bring up the SPY, that we don't break the morning lows. Why is that critical? Well, for one thing, it corresponds with this 31-day rally above this purple line, which is our 8-day exponential moving average. The low of the day today on that is 73.9750. That's spot on the 8-day moving average. There's no way around saying that that would be a change in character. Now it's a minor change in character because this is the shortest term moving average that we track, and 31 days is a long time. It may actually be 32 days, but it's up there. And a pullback to the 21-day moving average would feel extremely harsh, but it would be, to quote Mike Webster, normal and natural. We pull back to the 21 all the time. The issue is it's going to feel a lot worse because of how the ATR on a bunch of these leading stocks, that's the average true range. The average true range on the S&P 500 is below a 1. That's where we need it. But the average true range on a lot of these leading stocks is 5, 6, 7 or more % on a daily basis. So you get and knowing that these stocks can pull back 2 to 3 times what the overall market is doing. A 1% pullback in the S&P could equal an 8, 9, 10% pullback in a leading name. So what do we do to calm our emotions? Let's stick with facts and not stick with feelings. Ted and Connor made a great point on the IBD podcast earlier this week. They said, and Justin actually brought it up, our rebar calculation, that's Revere Estimated Balance at Risk. Every day we go in and we quote it on the tail of the tape during our nightly videos. We know going in how much we're willing to lose across every holding in the portfolio. And if our stops get hit, we're comfortable with that because they're placed in a logical area that would signal either a failure in the trend or a change in the trend. And we're either cutting losses or locking in profits. So we're very happy to say this double-digit move off of the lows that we've seen in our individual portfolios. Our stops have been raised to lock in about half of that gain, which is perfectly fine. The market ebbs and flows all the time. The important thing is that you never lose big. That has been it was during the YouTube Live with Ted and Connor this week, somebody commented, how do you guys recover from taking a big loss? And I was in the chat and I said, well, we don't have to because we've completely eliminated them from the possibility at Revere, of course, unless a dirty bomb goes off in Manhattan or something like that. But we've got stops that are either cutting losses to a very small percentage of the overall portfolio, and we're raising our stops to make sure we don't give back significant gains. So eliminating a big loss from your vocabulary, from the outcomes, from the possibilities, make sure that the only possibilities, there's 5 that could happen: a big loss, a small loss, a break even, a small gain, and a big gain. Eliminate the big loss. You should only either be small losses, break even, small gains, or big gains. And the big gains make up for all the little paper cuts. And that's what gives our approach a positive expectancy. We know when to back off the gas. We know when to press the gas. And we go through it every night on our video. So what are we focusing on right now? Certainly right now, that 8-day moving average on the S&P 500 in today's lows, 73.9750. Next level down there is the 21-day moving average. We got to almost 4 ATR above the 21-day moving average, and that's extremely stretched. We did on the NASDAQ 100 get to 4 ATR above, and that's on when I did Wednesday's video, we put the yellow caution light on our short term because of getting too extended. So not a surprise that we're pulling back at all. But now what we look to do is isolate relative strength to see what we're going to get stopped out of, and are there any candidates to replace those. So let's go through a couple names that are acting well. Some things that we own in Grotection: Datadog showing extreme strength, and Starbucks not really showing relative strength since the purchase, but it's showing relative strength today. Some things that we don't own, but we're keeping an eye on. Cisco had a strong run and then a big gap up on earnings. SanDisk is bucking the trend today in the big four memory names. It's positive. The other three are down on the day, such as Micron. And DRAM is the ETF that we own in Grotection for that. This has been a fantastic trade. It pierced the 8 EMA for the first time today, but is right back above it. A break below that 50 level today, and I'll be closing this trade out. What else is acting well? Eli Lilly, on a relative basis, hasn't been the best lately, but it cleared this 1,000 level, and it's basically flat on the day. Any stock that's flat on the day, or when the market is down 1.1%, you want to take note of these names and keep them on your watch list. You always want to know what's working and what's not working. So back to something else I want to show here, the equal cap weighted RSP. Look at how awful the relative strength line has been on this. And this is plain and simple because growth stocks have been dominating value stocks. And it's breaking the 21-day moving average today. This will be the first chink in the armor on our trend gauge when we update tonight. If the RSP, if the mid cap index, which has, that's not the one we want S&P 400. This is also breaking the 21-day moving average. IWM, I mentioned that small growth names have a big issue with rising interest rates. This is presently breaking below the 21-day moving average today. So the strong names, this has been a very tech-heavy rally, very AI-centric, and they're pulling back today. None really getting destroyed, none breaking their 21-day moving average. One that is Credo, CRDO. We owned this in Grotection until 10 a.m. this morning when I pulled the ripcord and we got stopped out of that. And it's below the 21-day moving average. So you want to track things that are holding up well. You also want to track things that have been leading and might be weakening, such as REMX. This started showing weakness over the last week on a relative basis. TurboTection stopped out of it yesterday in their portfolio. Something else that had been acting well and holding up and is seen as certainly a growth area is uranium names. Here's the uranium ETF also breaking down. CCJ was one of the leading stocks. I got stopped out of this earlier this week. So two of the themes falling by the wayside, rare earth metals and uranium. What's going to replace them? Well, we are seeing a resurgence in some software. Connor's going to talk about that. And we're also seeing cloud software names also acting well. So software's gone from just completely being beaten down to showing serious relative strength over the last week or two. We're going to talk about that. And Ted's going to talk about some earnings winners that we've got our eyes on. So with that, let's go back to the S&P very quickly. Holding on to that 8 EMA as of noon Eastern time on Friday. And let's take it over to the fellas now. We're going to start off with Connor, and he's going to dive into some leading cloud software names. Take it away, Connor.
Yep, so we'll start with the big picture view, and we'll take a look at CLOU, which is the broad ETF for this. This is the cloud computing ETF, and you can see the recent relative strength that it has been showing. And one thing that we've seen in the market is the spread between broad software versus semiconductors has gotten quite extreme. And what I mean by that is that software really has been in the doghouse for a bit now, but in this earnings season, we've seen a change in character. And when you see multiple stocks from the same group, same sector, gapping up on earnings and holding the gap, that's a big sign, especially when they're coming out of big periods of neglect and underperformance. And so some of the top names in this ETF, we'll start with DOCN. And this is a prime time example of gapping up on earnings, huge volume, and the action that it's doing right now is you really couldn't ask for better action. It's tight at the highs. It's holding, it made a day two higher high, and now the AEMA is catching up. And if you go to the the weekly chart on this one's also just coming out of a big base, and when a stock runs up into like the left side and the top of the base, people can think it's very extended, but you have to zoom out and think that, hopefully not, but there's probably some people out there that had been holding the stock all the way down, and just now they're getting into a profit. And, once the stock makes a green line breakout, no one knows how high it can go, but making new 52-week highs is very bullish. And this is one of the perfect example of, one of the software names gapping up on earnings out of a big base into highs, and it's acting extremely well. We'll take a look at another one, Twilio. This one also is in the CLOU, and same thing here. This one gapped out of just a huge base on earnings, made a day two higher high, and what is it doing now? It's consolidating at the highs, showing major RS. When you look at the volatility in these names, the price action is very tight, very linear, versus starting to see more erratic price action in some of the semiconductors because they're very extended, whereas we're seeing fresh new merchandise space that's gapping up on earnings. Twilio looks fantastic here. And then the last one, we'll take a look at Datadog. Again, same thing here. This one gapped up on earnings and it continues to trend higher. So kind of what we're seeing in price action here, it looks like a lot of Wall Street is buying these earnings gaps in these cloud computing software names, and kind of getting a re-rating after being laggards for many, many months. And typically that's what you see. Earnings gaps is typically what triggers a change in trend, a change in leadership. And there's so many of these software stocks that have gapped up on earnings, and that's always a huge tell. So that CLOU ETF's really good one to track. Look at the names in there and then look at the specific names. And these are three of the best examples that I could find for this space, all acting really well. So keep an eye on these stocks, and their moves very well could just be getting started.
Great stuff, Connor. All three of those are positions in Grotection, and I know Turbo is stalking them for entries for that portfolio as well. Let's move on now to Jackson. He's going to talk about another software subsector, and that's going to be cybersecurity, which was beaten down for a while but making a tremendous resurgence. We're going to start off with the broad ETF CIBR. There are other ones, but nice cut base form in here. Jackson, tell us about it.
Yeah, absolutely. Thank you, Don. Excited to be here today. Yes, this recovery has been really incredible, and I want to first start by kind of pointing out that failed breakdown at around that 60 level there. You can see the prior lows to the left from the April tariff crash, and it was interesting to see as all the Anthropic headlines and other AI related headlines were in a way kind of debasing cybersecurity as a group and providing negative catalysts for a period of time. This went through a significant and prolonged correctionary period, and then we started to notice support off of that 60 level and a potential bottoming pattern. Now, as you can see, that took quite a bit of time, 3-4 weeks there before relative strength started coming back in. And as we got some of those positive divergences, you can see the moving averages had to correct order. And now from an O'Neill standpoint, as you can see on the market surge chart there, we are just now back at all-time highs in the pivot. So as we go through some of the leadership names after this, you'll be able to see this group is clearly getting some healthy rotation and love as money's flowing out of other more extended groups within the market, but is also potentially very fresh and ripe for new buys going forward after we get some digestion of this preliminary move off the lows. So moving on to Crowd as our kind of big bellwether, high market cap cybersecurity name. And CrowdStrike here, you can see almost a 1-for-1 with CIBR. These cybersecurity names are very heavily invested in 3 names that we will cover today. But CIBR showing CRWD showing immense relative strength here, just at the pivot, and has just been in kind of this frozen rope trend up the right side of this base. And so now, while short-term extended would just be looking for either a handle to the cup here or some kind of sideways short-term consolidation or digestion. Moving on to FTNT. It's a little bit different in terms of strength and more so similar to the names that just reviewing. As you can see, we have an EP here, big earnings gap last week, and some nice follow through to new all-time highs. Same situation, just waiting for digestion. But with these names being so fresh, if you remember the way SOX looked at new all-time highs versus how CIBR looks, there is some potential upside here as this group takes a breather. And then lastly, PANW, also working up the right side, pushing out to new all-time highs, and just really showing immense strength. And as we've seen with many names, right? SanDisk, Light, all of the biggest winners of the past few years started with giant weekly, monthly digestive periods, and really started their runs with major catalysts and looked similar to this at the beginning of the run. So a group to keep an eye on, and we'll be paying attention to this closely going forward in all of our portfolios here at Revere. So Don, passing it back to you.
Yeah, great point, Jackson, that we really do want to see some sideways or mild pullback action on these after, I mean, you can see here up 7 days in a row on Palo Alto, but they say, and I agree wholeheartedly, that sector rotation is the lifeblood of bull markets, and we are certainly seeing money flowing into software names over the past couple of weeks. Great stuff there. We're going to move it over to Ted now, and he's going to talk about some names that are not frequently mentioned, but should be on your watch list. And let's start off with INOD, Ted. Tell us a little bit about what these companies do and why you're watching them.
Yep. Thank you, Don. So yeah, we're in the midst of earnings season, and like we've talked about in the past, during earnings season is a great time to spot out the potential next big winners, because you'll see them have huge beat and raises. You'll see the CEO, CFO, and executive team use words like inflection point or raise 40-year guidance, better than expected, surprise. Some of those key words can signal that this company is on for a growth trajectory. So the first one, INOD, it's a data engineering company for AI model training. You train these models, a huge part of it is power, but another big part of training these models is massive amounts of data. And that data has to be structured and organized in a way so that the models can interpret it and take it in. So they had a double beat on earnings, beat on revenues. They had a record Q1 of 2026 and higher guidance with a $51 million big tech deal as well. It's gapped up on highest volume ever. And during earnings season, definitely pay attention to the highest volume ever, highest volume in 1 year, and highest volume since IPO gappers. It just means there's huge buyers coming to that stock on a surprise as well. So this INOD pushed into new all-time highs, but came back in and now is flagging perfectly. So all 3 of these names I'm going to mention today are near actionable or even actionable at this very moment that we're speaking. So INOD building a flag here. That 8 EMA is catching up, and we're just tracking it, paying attention to it, especially looking at that left side area, 94-ish, 95-ish, which is right where it's trading right now. So next name, also data center AI infrastructure related, is AAON. This is an HVAC company entering the data center vertical. If you go on a weekly, Don, this really has been going nowhere for nearly a year or even longer. And you can just tell the story of this stock has changed. You can see that triple digit earnings in the last, if I can read that right, at least the last quarter, I see triple digits and high double digit revenue growth. And this gapped up into new all-time highs briefly, pulled back in, and now is building a really textbook flag here. What happened with them is they had double beat and raise. They had a 65% earnings surprise, 29% revenue surprise, and then they raised their fiscal 2026 year revenue growth. They almost doubled it. So before they were expecting 18 to 20% growth, and now they're expecting 40 to 45%. And that is what I was saying before, with huge guidance raises and surprises. And then they also said their data center demand backlog is at a record. Again, that keyword record, $2.1 billion. So paying attention to this one as well. You can see that earnings line topped and entered a downtrend, and now potentially starting to enter back an uptrend. So potentially this is entering a new growth cycle as well. And then the final name is more downstream of power, energy, infrastructure, chips, and even models. It's an application layer. So they build autonomous drone infrastructure. They have counter UAVs and artificial intelligence embedded in all their drones. This one also gapped up on very big volume. Huge report as well. They raised fiscal 2026 revenue view to 390 million, consensus with 380 million. And this is a 670% increase from 2025. And then they also had a 1000% revenue growth for this quarter too. And you see triple digit, quadruple digit revenue growth. That could be a huge sign that this stock might be entering a new growth cycle. And then they also have a $457 million backlog as well. And this one didn't gap out of the base, so you didn't need to buy on the gap. It's actually reversing back into the base off that, can't see that level, 11.5-ish. So maybe if this tightens up here, all those moving averages are converged too. So there's that launch pad setup that Jackson talks about. And if we get an entry here, this is pretty interesting, especially with drones being used at a massive scale in Ukraine-Russia war, as well as in the Middle East. So this is definitely the future of warfare. It's pretty clear at this point. Anduril also raised many, many more billions, doubling their valuation to 61 billion as well. So that is kind of like the market leader that's in the private markets, leading the way. And it's clear that war is transitioning to drones. So these are three setups that we're watching, three interesting themes as well, and three big beats on earnings. So just tracking them, looking for entries, and that's it.
That's it. All staying prepared. They be prepared. They teach it in scouts when you're young, and it really applies to all phases in life, especially when you're a growth stock trader. You got to be prepared for moves to the upside to get involved and moves to the downside to protect capital. That's what we're all about here at Revere, is growing capital in uptrends, protecting it during downtrends. And since mid-February of this year, if you stayed with us on a nightly basis with our videos, you watched how we reduced exposure as we started breaking some key moving averages, how we went to near flat or fully hedged as we started to break below the 200-day moving average, and then how we re-engaged the market. First on the indexes regaining some short-term moving averages, and then on the classic O'Neill follow-through day in early April that worked perfectly, kicking off this latest rally. And the thumbnail this week is the Revere guy with the dollars in his lantern riding a bull on a surfboard. And that's what we're doing right now. Ride the wave. There we go. A little bit of applause there. We don't know when it's going to end. We don't call tops. We do point out when we're extended. That means don't throw a bunch of money in the market when you're near all-time highs, especially in names that are far extended from optimal buy points. Ideally, you want to see some things that are coming out of bases, very similar to what we showed on some of our segments this week. If they're just coming out of a base, that just means they've got a long way to go higher. And if they don't work, which happens all the time, we're wrong often, but we don't stay wrong. And when we are wrong, we're wrong small. Once again, just completely eliminate the possibility of big losses from your portfolio, and then imagine watching how it grows. And it's certainly knowing what your downside is on every position going into every day. That means that you've accepted the risk, and it takes a lot of stress off of you not having to panic sell anything because the market's down. And then it's just taking it one day at a time, one trade at a time. And it's not easy. There's a lot of rules to it, but we're market technicians here. We can certainly tell the difference between a healthy market and a risky market, and give the market the benefit of the doubt as long as it's trading above all of the 4 moving averages that we have on here. That's the ultra short term 8-day exponential moving average, the short term 21-day moving average, the medium term 50-day moving average. And no bear market in history has ever occurred until a break below this black line. That's the 200-day moving average. Doesn't guarantee you're going to get a bear market. We give it 3 to 4% leeway to show if it's really going to go lower. It didn't work out for us this time. The market made 1 day lower after we completely got out of the market before having a gap to the upside. It did certainly help out last April with this break of the 5,500 level, as we were able to dodge all of this. This is a 10% move lower, and then simply followed our rules to re-engage as we got back above the short-term moving averages, and there was follow-through days mixed in here. April 23rd, I believe, was the one that really kicked off another big rally in the market. It's why we follow O'Neill. His time-tested rules work. And with that, I am going to throw it back to the spirit of Dan to take us on home. All right, Don, thanks so much. If you're at home, you got to ask yourself, is your advisor doing this? Does your advisor have a plan for the market going higher and the market going lower? Or does he just sit there and click the rebalance button a couple times a year? That's not what we do at Revere. So if you like what you heard, tell your friends, tell your family, go to revereasset.com, and we'll see you next week on Your Money. Not their money, your money. Because it's not about how much you make in the markets, it's about how much you can keep.